Greetings everyone and welcome to our panel discussion on contemporary issues in monetary policy. Today's discussion will explore how modern monetary policy is used to address inflation, financial crisis, economic uncertainty, and the growing influence of financial technology in the global economy. As we know, central bank today faces increasingly complex challenges from stabilizing inflation and maintaining economic growth to responding to financial crisis and adapting to digital financial innovations. Our discussion will focus on important areas such as monetary policy transmission mechanisms, unconventional monetary policy tools, central bank credibility, financial crisis, and the future of monetary policy in a digital economy. Joining me today are our panelists, each representing a different perspective within the field of monetary economics and financial policies. Through this discussion, we hope to critically analyze both the opportunities and limitations of monetary policy in today's rapidly changing economic environment. To begin our session, I would like to introduce our first panelist, Ms. Kyung Chuki, who is joining us from the perspective of a monetary economist. She will discuss the effectiveness of monetary transmission channels and evaluate how monetary policy models perform during economic crisis. So my first question to Ms. Kyung is, which monetary transmission channel is most effective in influencing macroeconomic stability, the interest rate channel, the credit channel, or exception channel, and why?
So thank you for the question. So now, to answer your question, I think that the effectiveness of monetary transmission channels really depends on the economic situation. But overall, the expectations channel is the most powerful in the modern economy, especially when compared to the interest rate and credit channels. Now, the interest rate channel is the most traditional one. When a central bank lowers interest rate, borrowing becomes cheaper, and this encourages households to take loans for things like housing or consumption, and it also encourages firms to invest more because financing costs are lower. So in theory, this increases demand in economy and supports growth. However, the problem is that this channel does not always work strongly in reality. Like, for example, if confidence is low, people may still not borrow even if interest rates are very low. Then we have the credit channel. While it focuses more on whether banks are actually willing to lend, this is very important because even if central banks reduce interest rate, banks might still be cautious. So during uncertain times, banks may tighten lending standards, meaning businesses and individuals cannot easily access credit. Now, this was very clear during the financial stress periods like banking crisis, where there is a credit crunch even when policy is expansionary. So the most important, in my view, is the expectation channel. This works through trust and confidence. Like, if people believe that the central bank is credible and inflation will remain stable, they adjust their behavior in advance. Like, for example, firms decide prices based on expected inflation, and households decide spending based on expected future income and prices. So expectation influence the economy even before actual policy effects fully transmit. And this is why central banks today focus a lot on forward guidance, which is basically communicating future policy intentions clearly. And if people trust the central bank, monetary policy becomes more effective overall. So to conclude, while the interest rate and credit channel are still very important in practice, the expectation channel is often the most powerful because it shapes economic behavior immediately and strengthens all other channels. That's all. Thank you.
Thank you, Ms. Kyung, for your answer. Your analysis clearly demonstrates the importance of the exception channels and how trust and credibility significantly influences the effectiveness of the monetary policy transmission. So now, moving towards the period of the financial stability and crisis, my next question to you is, to what extent do traditional monetary transmission model fails during the financial crisis, like the 2008 global financial crisis or the COVID-19 pandemic?
Thank you for giving me this opportunity once again. So traditional monetary transmission models, especially the Keynesian interest rate channel, do not completely fail during the financial crisis, but they become much weaker and less effective than in normal times. Like in normal economic conditions, the Keynesian view suggests that when the interest rate fall, investment increases, consumption increases, and overall economic activity improves. This works well when financial markets are stable and confidence is strong. However, during the 2008 global financial crisis, this mechanism breaks down. Like even though central banks lowered interest rates significantly, banks were very risky averse and stopped lending properly. So this created what we call as a credit crunch, where businesses and households could not access to loans easily. So even if money is cheap, it is not available. So that becomes the entire transmission process. And a similar situation happened during the COVID-19 pandemic. The central banks reduced interest rates to near zero and introduced the large stimulus measures. But in the early stage of the crisis, economic activity still fell sharply. Like this was not because monetary policy failed completely, but because the real problem was not just the interest rate, it was lockdowns, uncertainty, job losses, and reduced mobility. So the normal transmission channels were interrupted. So this shows that traditional models are based on assumptions like smooth credit flow and rational responses to interest rate. But in reality, during crisis, those assumptions do not hold. However, it is important to see that monetary policy still matters during this crisis. So it just becomes less effective during traditional channels. That is why central banks use unconventional tools like quantitative easing, liquidity support, and forward guidance to restore confidence and stabilize markets. So in conclusion, traditional monetary transmission models do not fully fail, but they become partially ineffective during crisis and need to be supported by broader financial stability tools. Thank you.
Thank you so much for that insightful explanation. Your response clearly showed that during financial crisis, traditional monetary transmission mechanism becomes less effective due to the reducing lending with confidence and economic uncertainties. You also highlighted the importance of unconventional tools such as quantitative easing and liquidity support in restoring financial stability and supporting economic recovery. Thank you so much for that. Moving on with the next panel, we have our financial market analyst, Ms. Sunam Thamu. So my question to you is, the central bank constantly faces pressure to fight inflation without killing growth. But we have also seen how badly things go when their credibility breaks down, as with the Federal Reserve transitory inflation calls in 2021. How do these two challenges reinforce each other, and what does it mean for the policy effectiveness?
Thank you for the question. Well, that's a very critical question. So these two challenges are deeply connected, and that's what it makes it too dangerous for both of them to arise at the same time. So the inflation growth trade-off is that the central bank's core dilemma: raise rates too fast and usual growth and employment, which moves too slowly. Inflation becomes entrenched. So the right balance depends entirely on what's driving inflation. So if the demand overheating, tightening works cleanly, but if it's a supply shock like energy prices or post-COVID bottlenecks, raising the rates crunches demand without actually solving the inflation. So you get the worst of both the worlds: recession and still high prices. So that's stagflation, and the 1970s shows us how painful this can be. Now here's how credibility comes in. So if market and household trust the central bank to bring inflation down, inflation expectations stay anchored, and the bank doesn't need to tighten as aggressively. And it gets price stability partly for free, but the moment credibility cracks, as it did when the Fed called 2021 inflation transactionary for months while it was clearly broadening, the cost explodes. So the Fed then had to hike 500 and 25 basic points in 16 months, one of the most aggressive cycles in modern history, precisely because it lost that anchoring effect early on. So thank you, that's my answer.
Thank you for your answer. That was a very insightful explanation of how inflation management and credibility are deeply connected. So your discussion clearly showed that when central bank credibility weakens, inflation exceptions become unstable and forcing policymakers to adapt much more aggressive actions later on. Now, I would like to move on to our discussion towards another major challenge faced by the modern central banks. The issue is political influence and the global financial spillovers. My question to you is: the central bank faces pressure from two directions. Domestically from government wanting easy money and external from the spillover effect of major central banks like the Federal Reserve. So how do the political and global pressure limit what monetary policy makers can do?
Thank you for the question once again. So this is really about the limits of sovereignty in monetary policy, and the answer is that those limits are more binding than most people appreciate. On the domestic side, political pressure is real and persistent. So government have a neutral bias towards the low rates, cheap borrowings, high growth, happy voters before elections. So the whole point of central bank independence is to insulate monetary decisions from the short term. But independence is only as strong as the institution protecting it. Turkey is the starkest recent example. President Erdogan pressured the central bank to cut rates even as the inflation is 80%, arguing against all the mainstream economics that high rates cause inflation. The lira lost over 80% of its value between 2021 and 2023. That's the real world cost of politicized monetary policy. The global dimension adds another layer of constraint. When the Fed tightens, the dollar strengthens, capital flows back to the US chasing higher yields, and emerging market currencies come under several pressure. So central bank in those countries are then forced to raise their own rates, not because their domestic conditions demand it, but simply to stop capital flight and currency collapse. So in 2022, countries from Sri Lanka to Pakistan to Argentina face exactly this, with Sri Lanka ultimately defaulting on its sovereign debt. So Raghuram Rajan, former RBI governor, captured this perfectly. The Fed sets policy for America, but the world bears the consequences. So there is no meaningful international coordination mechanism to address this asymmetry, which is why global spillover risk remains one of the most structurally underpriced risks in the financial market today. Thank you.
Thank you for your answer. Your response clearly demonstrated that monetary policy makers today operate under significant constraint, both domestically and internationally. On the one hand, political pressure can undermine central bank independence and push policymakers toward short-term decisions that may damage long-term economic stability. And on the other hand, the global spillover effect, particularly from the major central banks like the Federal Reserve, can force smaller and emerging economies to adjust their policy and even their domestic conditions, which may not be required. To move on to our next panelist, we have our Ms. Pema Dema, who will speak from the perspective of the central banker. She will discuss how central bank use monetary policy tools to control inflation and stabilize the economy during uncertain periods. My question to you is, how do central bank uses monetary policy tools to control inflation and stabilize the economy during the periods of economic instability?
Thank you for the question. Central bank plays a very important role in maintaining macroeconomic stability by controlling the inflation, managing money supply, and supporting the sustainable economic growth. During period of economic uncertainty, such as financial crisis, pandemics, or the inflation shocks, central bank use several monetary tools to stabilize the economy. So the first and most common used tool is the policy interest rate. When inflation becomes too high, central bank increase interest rate to reduce the borrowing and spending. So higher interest rate make loans more expensive and the loan more expensive for the household and the business, which decreases the consumptions and the investment. As the aggregate demand falls, inflationary pressure gradually decline. On the other hand, during the recession or the slow economic growth, central bank reduce the interest rate to encourage borrowing, investment, and the consumer spending. For example, after the COVID-19 pandemic, many central banks such as Federal Reserve and the European Central Bank, they reduced the interest rate to near zero to support businesses and the households. However, when inflation rose sharply in 2022 due to the supply chain disruption and the energy price increases, central bank increases interest rate aggressively to control the inflations. And the another important tools is the open market operations, where the central bank buys or sells the government securities. When central bank buys securities, more money enters the banking system, increasing the liquidity and encouraging the lending. When it sells security, liquidity decreases, reducing inflationary pressure. Central bank also use the reserve requirements, which determine how much money commercial banks can bank must keep in reserve, or the lower reserve requirement increases banks' ability to lend, while the high reserve requirement restrict the credit creation. And in addition, during the severe crisis, central bank may use the unconventional monetary policies such as quantitative easing. So under quantitative easing, central bank purchase large amount of government bonds and the financial asset to inject the liquidity into the economy and stabilize the financial market. However, monetary policy also faces the limitation. Interest rate changes may take time to affect the economy due to the transmission lags. Furthermore, if rates remain low for too long, they can create the asset bubbles and increase the financial risks. Therefore, central bank must carefully balance the inflation control with the economic growth. Overall, central banks must use the conventional and the unconventional monetary policy tools to maintain the price stability, restore the confidence, and support economic recovery during the uncertain periods. Thank you.
Thank you. That was an insightful explanation. Your discussion clearly highlighted how central bank uses both the conventional and unconventional monetary policy tools to maintain the macroeconomic stability, especially during crises such as the COVID-19 pandemic and period of high inflation. Now, I would like to ask you the second question, which is related to the unconventional monetary policy. Do you think the unconventional monetary policies such as quantitative easing are effective in managing the financial crisis? And what are the advantages and some of the risks?
Thank you for the question. So yes, I believe unconventional monetary policy, especially the quantitative easing, can be effective during the severe financial crisis when the traditional monetary policy becomes less effective. These policies are mainly used when interest rates are already close to zero and the central banks cannot stimulate the economy further through the normal rate cuts. So quantitative easing involves central bank purchasing large amount of government bonds and the financial crisis from the market, as I have already mentioned. This increases liquidity in the financial system and encourages banks to lend more money to businesses and the household. The main objective is to lower the long-term interest rate, increase investment, improve market confidence, and the support economic recovery. And a good example is that in 2008 global financial crisis. During this period, the Federal Reserve implemented several rounds of quantitative easing to stabilize the financial system and to prevent the economic collapse. Similarly, during the COVID-19 pandemic, central banks around the world to use the quantitative easing and the liquidity support programs to maintain the financial stability. So, one major advantage of quantitative easing is it helps restore confidence in the financial markets during the times of panic by injecting the liquidity into the economy. Central banks can prevent credit freezes and reduce the risk of financial failure. Quantitative easing also support employment and economic growth by encouraging spending and the investment. Another advantage is that quantitative easing can reduce the long-term business borrowing cost for the governments and the businesses. This encourages infrastructure investment, business expansion, consumer spending, which can stimulate the economic activity. However, unconventional monetary policy also have severe risks and criticism. One major concern is inflation. If too much money is injected into the economy for a long period, it may increase the inflationary pressure. Another issue is that the possibility of creating asset bubbles in stock market and housing markets because investor may take the excessive risks due to the low interest rates. So there is also criticism that the quantitative easing mainly benefits wealthy individuals who own financial assets, increasing income inequality. Furthermore, a prolonged dependence on the central bank support may create the moral hazard where the financial institution make excessive risks expecting the future bailouts. Additionally, existing from the quantitative easing can be difficult when central banks attempt to reduce their balance sheet or increase interest rate later. Financial market may react negatively. In conclusion, unconventional monetary policy are powerful tools during the major crisis and have helped many economies avoid the deeper deeper recessions. However, they must be implemented carefully and combined with the sound fiscal policy and the financial regulation to minimize the long-term risks and ensure the sustainable economic stability. Thank you.
Thank you so much for sharing those valuable insights. Your explanation effectively showed how quantitative easing and other unconventional policies can help stabilize financial markets during the severe crisis, which also creates a concern such as inflationary pressure, asset bubbles, and financial risks. We will now move on to our final panelist, who will present a perspective as a policy critic and fintech expert, and she is Ms. Lichen Wangmo. She will discuss how financial technology, digital currency, and innovation can reshape the future of monetary policy. My first question to you is, as decentralization cryptocurrency gains transitions, many central banks are developing central bank digital currency or the CBDCs. So from a policy and a risk perspective, how do CBDCs differ from private cryptocurrencies, and how they can successfully protect the sovereignty of the traditional monetary policy?
Firstly, thank you for the question. This is a central dilemma of the modern digital microeconomics. We have to separate the private cryptocurrency like Bitcoin from the CBDC. Private cryptocurrency are decentralized and even it is a highly volatile asset that can be operated outside the regulated banking system. Because they lack a central issuer and even they poses a significant risk of currency substitutions or dollarization in digital form, which directly threaten central bank control over the domestic money supply. And when we talk about the CBDC, it's not a new currency, it's simply a digital form of sovereignty fiat money, which is direct liability of the central bank. And if I tell you the critics and the policy constraint, while CBDC are designed to defend the monetary sovereignty and enhance the financial inclusion, they introduce severe structural risks to banking system stability. For instance, during a financial panic, a retail CBDC make it incredibly easy for consumers to initiate a digital bank run by moving their commercial bank deposit into a risk-free central bank digital account that click of a button. And this commercial disintermediation could severely impair a critic channel of the monetary transmission mechanism, making it harder for commercial banks to issue their loan to the real economy. Therefore, while CBDC offer analytical tools to counter the crypto asset, they simultaneously create a massive policy constraint for the monetary authorities. Thank you.
Thank you. Your explanation clearly differentiated CBDCs from the private cryptocurrency, while also highlighting the potential risks they may create for the banking system and the monetary policy transmission. Now, my final question for today's discussion is, how do the digital payment innovation and the fintech platform alter the traditional monetary policy transmission mechanisms, and what challenges do they create for controlling inflation and the growth?
Thank you for the second question. Fintech innovations such as a mobile wallet, digital-only neobank, and peer-to-peer lending platform, they fundamentally speed up the velocity of the money. By bringing millions of previously unbanked individuals into the formal financial ecosystem, Fintech drastically alter the interest rate and credit channel of the monetary transmission. And some of the structure shift here is, in a traditional economy, when the central banker policy increase the policy rate to decrease the inflation, the transmission relies on the commercial bank slowly adjusting their deposit and lending rates. Fintech platform, however, bypass the traditional banking friction. Algorithm and the automated platform can adjust interest rate instantly, which might accelerate the speed of the policy transmission. And the policy changes here is, however, this create a major blind spot of the policymaker. A substantial portion of credit is now granted through non-bank fintech algorithm. They rely on the alternative data rather than the traditional collaterals. This platform may not respond to the central bank interest rate signal the same way traditional bank does. If a blooming fintech credit market continues to lend aggressively despite the contractional monetary policy, it dilutes the central bank ability to balance the inflation versus the growth trade-off. We are moving into an era where central bank might lose their monopoly on managing the macroeconomics liquidity because the plumbing of the financial market is shifting to the private tech firms. Thank you.
Thank you for this insightful values. Your response effectively demonstrated how digital finance and fintech innovations are transforming traditionally banking systems and creating new challenges for monetary authorities in maintaining economic stability. As we come to the end of today's discussion, today's session has shown us that monetary policy is no longer limited to simply adjusting interest rates. Modern central banks must now manage inflation, financial crisis, exceptions, technology disturbance, and global financial uncertainty simultaneously. Our panelists have also highlighted that while monetary policy remains as one of the most powerful economic tools, its effectiveness depends heavily on credibility, financial market stability, public confidence, and the ability of policymakers to adapt to changing economic conditions. On behalf of the panel, I would like to thank every one of you for attention and participating throughout the session. I would like to sincerely thank all our panelists for sharing your insightful values and perspective. Thank you and have a great day.